Hi, today we are decoding return on equity or ROE. It's the single metric that separates a good business from a great investment. For legends like Warren, Charlie, or Peter Lynch, ROE is the ultimate yardstick for management capability. Warren once wrote that if a business can't generate a decent return on the money it already has without drowning in debt, it's probably not worth your investment. Suppose you have 100K to start a business selling protein powder boxes. Think of this as your seed money. You spend it on the basics, like buying your initial stock of 2,500 boxes, leasing a warehouse, and setting up your online store. You're simply turning cash into a business that's ready to work. Fast forward 12 months, you've sold all your stock, and your business shows a total revenue of 200K. But as every business owner knows, revenue isn't what you actually get to keep. We have to pay bills first. First, we have to pay variable costs. This is the 125K spent on those 2,500 boxes. These are variable because if you don't sell a box, you don't pay this cost. Then we have fixed costs. This is the 25 grand for the fixed expenses like warehouse, rent, and staff. You pay these regardless of how many boxes you sell. Then finally, you pay a tax bill, which is 10% assumed here, which is $5,000. That leaves you with $45,000 in net profit. And first, we look at net profit margin, which is 22.5%. This tells us how efficient the business is at keeping the revenue it generates from those protein sales. Next is earnings per share. If we divide the business into 100 equal shares, each share earned $450. This tells us the profit belonging to a single slice of ownership. Now, margin tells us about sales efficiency and EPS tells us about share value, but neither tells us how hard our original 100K investment is actually working. This is where we calculate return on equity. By dividing our 45K profit by our 100K investment, we get an ROE of 45%. A 45% ROE is a high ROE, and it means that for every dollar of equity inside the business, management generated 45 cents of pure profit in a single year. But keep in mind, this is a simplistic example. The real test of a business starts now. What does the management do with that 45K profit? Ideally, they should reinvest into the business if they can generate an even higher ROE, and that's the real test of that business. If they can't, the money should be returned to shareholders through dividends or buybacks. But we'll deal with that complexity in a later video. When comparing metrics, margin measures pricing power and sales efficiency. Earning per shares or EPS measures shareholder value, but ROE measures investment efficiency. It shows how hard management is making that initial seed of money work. For this to be a pure 45%, we assume a closed system. That means no new shares were issued and no buybacks happen. The investment base stayed exactly at $100,000 all year. By measuring ROE, you measure the true capability of management to multiply the capital you have entrusted to them. You don't need a finance degree, you just need to look at the engine. See you in the next video. Ciao.